Stacey Cunningham. I'm excited to be here today and host the market structure panel here at the Pissarro Center. First, I'd like to start off with a huge thank you to Mike Pissarro for having us here at the Pissarro Center, and to Professor Agarwal for everything that Georgetown does for markets, finance, public policy, and way beyond all of that. A year ago, we sat in these seats. I didn't need reading glasses, but I do today. So I will start introductions. We have Jim Angel, Associate Professor of Finance, Georgetown University McDonough School of Business. We have Sapna Patel, Head of America's Market Structure and Liquidity Strategy at Morgan Stanley. Hope Jarkowski, General Counsel, New York Stock Exchange. And we have Jeff Davis, Senior Vice President and Senior Deputy Counsel at NASDAQ. So we could not sit here today on a market structure panel and not talk about the market structure reforms that the SEC has proposed. So there are a number of proposals out there, but four main equity market structure reforms. In their initial form, what do you think would have the most significant impact out of all of them? And I'll start with you, Jim.
Well, I think the real problem with the proposed reforms is nobody's really looking at how they all go together. Now, clearly, the retail auction proposal would have some of the biggest impact, and I noticed that nobody actually seems to like it. Even the exchanges that would presumably benefit from it, you have put in comment letters saying, hey, it's not really ready for prime time. Some of the things I think make a lot of sense, like the reforms to Rule 605, but it's really too much too fast.
All right, Sapna, which one do you think will have the most impact, and good or bad?
Okay, I agree with Jim. They are interconnected. You can't look at any of them in isolation. The question that I ask, though, is when you see a fundamental change like the one contemplated by all four of these proposals, the question that I initially would ask is, what problem are we trying to solve for? Mm-hmm. And I think that's the question that a lot of us are scratching our heads on, because our markets are fairly efficient. We've heard statements like they're the gold standards, our equity markets are the gold standard of the world, that retail's never had it better, that institutions trade very well, costs have never been lower. So what are we trying to solve for? And the SEC themselves have represented that the markets work efficiently, but they want to try to make them better. Mm-hmm. So the one thing I would say is, if we're trying to make things better, and nobody's saying our markets are perfect, right? You can pick different market structures globally. There are pros and cons to every structure, and we should continue to optimize them. But if something's working fairly efficient, I think we should take a step back and be careful about breaking something that actually works for investors. And so when we talk about four interconnected proposals, all changing different variables all at the same time. And look, I'm not the smartest person in the room, but I'm smart enough to know that if various market participants all wearing different hats, exchanges, broker-dealers, buy-side, academics, former SEC officials are all saying this is not good for the marketplace, or we have consensus views on things, maybe you should listen. So are they listening? I mean, there's a comment period. There a lot of feedback has been shared. What do you think will come from the feedback that's been shared? And Hope, why don't do you have any sense, or what's your crystal ball say? Or at least what's the consensus of how people are reacting? I similarly,
think, there's broad support for Rule 605 changes. I mean, it's hard to argue against additional transparency. So if they want to move something that's going to put them in a safe litigation posture, that would be the one I would expect them to do. The Best X rule, if they go along the lines of what many have said, which is harmonize with what FINRA already has and is well understood in the industry, I think that would be a much easier the lift than where they currently are. So that would be my prediction. The other two, the order competition rules, very controversial, and surprisingly, it doesn't provide as much opportunity for exchanges to compete unless we're allowed to innovate through our RLP program. So I think if we've argued that they should stagger them and implement them in a more orderly fashion than they're currently proposed.
Similar views, Jeff, or
very similar. I would only add that there seems to be a consensus developing around ticker reform, and this is something that NASDAQ has been advocating for a long time. We have said continuously it should be done in an incremental and careful way, And there does seem to be a consensus building around a half-penny tick size. And we think that that is a sensible step to take. Our concern was basically the proposal took 3 steps, right? It just went too far, too fast, as Professor Angel was saying. So we're hoping the commission is listening. Our sense is they are talking to a lot of market participants. So we're hoping they're listening.
It actually the tick size going to half a penny actually addresses a market structure problem. So with respect to what I was saying, what problem are we trying to solve for? If stocks would actually trade at tighter spreads, but they're artificially constrained by a penny tick, maybe we should go to half a penny for those.
We had really high hopes based on the early commentary about the strengthening of the NBBO, which we think is really critical for all aspects of the performance of the market. And really, the tick reform, from our perspective, is the only one that really focuses on strengthening and deepening the NBBO. The others, particularly the order competition rule, it's just hard to see how the market and investors are going to benefit from that.
Well, it's interesting in that under Reg NMS, there were 4 major proposals that happened at the same time. And it's really hard to show what the causation was from any individual thing when so much else was changing at the same time. And here we are again.
Difference, though. So I worked on Reg NMS at the SEC.
No offense.
We actually were trying to solve for something at that time. And so, I mean, you think back to 2000 and what was happening around then, that's where I started my career at the SEC right out of law school. And we were going from fractions to decimals. We had electronic trading desks pop up on the street. We had clients starting to use algorithms. Things were automating. And the volume was predominantly done at the New York Stock Exchange, and NASDAQ had filed for exchange application status. And so sitting at the SEC, you're thinking, we have a floor-based exchange and we have one that's going to be automated, and you're going to have 2 separate sets of rules. So let's force everyone into automation to a certain degree. New York Stock Exchange created hybrid at the time. But when the SEC went through Reg NMS, which was the last major overhaul to our equities markets, we engaged with the industry. So it was 4 proposals that were all interconnected, but all the analysis was done across all of them, right? What we have with the 4 proposals today are individual proposals where I don't think there was thought given to this one and the people working on it versus who was working on the other ones. And so we not only put out a proposal for Reg NMS, we had a public hearing in New York. We got industry feedback on it. Based on the industry feedback, the SEC changed the rules, reproposed before they went final, and there was a gradual rollout process. That's not happening here, and that's part of the concern. I mean, to Hope's point, you would think the auctions would benefit, the retail auctions under the order competition rule would benefit the exchanges, but the way that the proposal is drafted, it really doesn't. It harms retail and it doesn't benefit the exchanges. But we have retail liquidity programs on the exchanges that haven't been optimal. Why not? There is a regulatory carve out for exchanges to execute in a tenth of a penny. Why is that not working? How do we optimize that so the exchanges can compete on size and price improvement?
Right. So there's so many different proposals, those that have been well vetted over the years and others coming, but it doesn't stop there. So now we have an exchange volume tier proposal that more recently just came out. So maybe not everyone has seen it. Sapna, do you want to just describe what the proposal actually says?
Sure. So exchanges have volume tier pricing, and
customers get better pricing for scale.
Customers get better pricing for scale.
Not a new concept.
Not a new concept. Has existed for a while. The SEC is looking to ban volume tier pricing for customer flow. They'll permit it for proprietary flow, but for customer flow, they believe that brokers are conflicted and are routing to the exchanges in their own interest, not necessarily the interest of their customers, and that they're pocketing the money. And I think part of the premise behind the change is smaller and mid-tier brokers can't compete with the larger broker dealers like mine, who are the beneficiaries of this tier. And smaller exchanges can't compete with NASDAQ or the New York Stock Exchange for order flow because of the volume tiers as well. So it goes back to, it's just dispelling a lot of myths. So it's not like broker dealers like mine are collecting these rebates on the exchanges and pocketing the money. We have something called plus billable models where we pass on the economics, the fees and the rebates to our customers. It's offered to all customers. Broker dealers can absorb that, including exchange broker dealers, quantitative customers and hedge funds can as well. And we have smaller and mid-tier brokers that use us, and they get the benefit of the pricing, but they use us for scale. They're not connected to all the exchanges out there. They don't have the infrastructure. They can't take in the proprietary feeds and pay for them. They are not members of all the exchanges. They don't have the market access tools that certain folks have invested in. So because of the scale, they use the larger broker dealers, but they are the beneficiaries of that order flow as well.
Were there conversations about how it works today in advance? Because you think that would be having events like this and talking about the way the markets work would be helpful so that the regulators understand, like, what are the problems that are out there?
The two things we said to the commission and commission staff when they were germinating this proposal, I mean, it went on the regulatory flexibility agenda. I think it surprised a lot of people. One, volume-based pricing is an virtually universally accepted economic principle. It is rational economic behavior. Two, our volume tiers are our best tools as exchanges for creating the NBBO, for incentivizing market participants to display liquidity, tighten and deepen the NBBO. And in the absence of that sort of market-based approach to driving the NBBO, we don't know what the commission thinks is going to substitute for that. And we are very, very concerned about the broadening, the widening of the NBBO. And frankly, if we can't compete on price with off-exchange venues, single dealer platforms and such, we're pretty confident the order flow is going to go there.
Which leads to a lot of volatility in the market too, when you don't see a strong NBBO and liquidity around it.
Right.
So moving toward more the topics that are coming up a lot now, we talk a lot about AI. And certainly that'll be a conversation piece that is part of today's session, I'm sure, in a number of conversations. We all would agree, I'm sure, that trust is paramount to the success of our financial markets. Investor confidence is really critical to our markets functioning as well as they do. But as we see new technologies combined with social media, there is some risk in how investors can be confident that how stocks are trading is reflective of supply and demand and not news or rumors. And so tell me, so I'll send this to the exchanges, how does NASDAQ solve that problem? And I'll start with you, Jeff. Like, what do you think about that from a regulatory perspective?
So we are all in on technology as a tool of market modernization. We've been on a cloud journey. Just this Monday, we launched our second market in the cloud on the option side. And we have really high hopes for AI. We had an order type approved by the commission just a couple of weeks ago that has an AI feature to it called the dynamic mellow order. We use AI tools to optimize our strike proliferation on the option side. We have plans on the surveillance side to harness AI to sort of unlock data, give us actionable intelligence for running our surveillance patterns. So we have really high hopes. There is this, I think there's a legitimate concern about misinformation in the market. I think what is striking to us, over a 20-year career, is we have always heard from the commission that their rules are agnostic to new technologies, that, fraud is fraud, right? And so it is striking to us that they're kind of deviating from their general view that they have the tools in place to combat fraud and specifying around AI, particular tools. So it's a little bit of a deviation. We gave some constructive feedback on their predictive analytics comment, and we're hopeful that they're listening.
Hope, anything to add or similar?
We use machine learning in our surveillances, as I imagine NASDAQ does as well. So it's a continued area of focus on the regulatory side of our organization. I think also, when you're providing tools for investors to access the markets, that's inherently a good thing, but it also comes with risks. And so obviously the risk of misinformation creates a degradation of confidence in the markets. That's the last thing that we want. So it's, investor education and access need to be balanced.
Yeah, when you see a degradation of confidence in the market, especially among retail, you see things that we don't expect to see, like the meme trading and meme stocks that we saw, and that retail investor activity started to spike in the spring of 2020 for a number of reasons. We saw it very emphatically in retail equity options trading, as well as meme stocks. It's starting to subside a little bit, but it's changed the profile of trading in markets in a lot of ways. How do we see how do we see that shifting and the balance between retail and institutional? So many of the SEC's proposals are in theory designed to protect the retail investor. Are retail investors better off? And Professor Angel, I'll start with you.
Yeah, well, I'm glad you mentioned the predictive data analytics proposal, a very broad proposal that tries to get into this aspect of let's protect people from being hoodwinked by all of these gamification techniques and predictive analytics. But I thought there was a very interesting step forward in regulatory thinking there. Traditionally, the whole foundation of our regulation for the last 75 years has been based on disclosure. Tell people what you're selling to them and let them make their own decisions. And in the SEC's release, they basically said disclosure doesn't work. And that, I think, is an amazing intellectual breakthrough where they realized that, hey, disclosure as we know it doesn't work. Putting something on, a footnote on page 800 of a disclosure in 6-point type really does not communicate. So we
My
really
reading glasses, I'm not sure they would see that.
So we really need to move from this disclosure, check the box, legalistic mentality into a communication-based system. Now, what that would look like remains to be seen, but it's the fact that they're actually admitting disclosure doesn't work is really a great step forward. So now the question we need to ask is what does work and how can we implement that?
Anyone else have thoughts? Is the retail investor better off? Go ahead, Sapna.
Well, I think the retail investor is better off, but what you were saying before in terms of this rise in retail trading that we've seen, I still remember the conversations we were having early pandemic, and we were all watching this, and there were a lot of conversations around whether this was a short-term bubble or whether it was a longer-term trend. And I will say I was wrong. I was on the short-term trend, little bubble side of the equation. I honestly thought that once we all went back to work and we didn't have the stimulus checks and we had television again and sports and all that, that it would disappear. And it was learning that we had this whole other investor base, this new generation that was investing in the markets that had different tools at their disposal. And that made it attractive for them to not only get into the markets, but stay in the markets. I think that's good for our marketplace. That's good for our country to a certain degree. And so we should be encouraging that.
Yeah, we should make sure they have a good experience because we want to see the next generation of investment. And not only do they have different tools, they have different goals. I mean, how many retail investors, especially younger generations who have thought about this differently? It wasn't 100% about making money on their trade. They were expressing an opinion, and certainly the meme stocks.
And that's one place where I think retail investors are going to be directly impacted by the SEC's rules. The short sale disclosure, I think, is a key component of responding to that group of investors' mistrust in the market. They thought the system was rigged against them. They were reacting to that. And that's a place where I think disclosure could really help. I don't know if the rules and that are coming and FINRA's changes are going to address that. But that's one place we have, kind of high hopes. T+1 clearing, I think, is an important advance forward. I think the market is going to be better off holistically, and that's an indirect benefit to retail investors.
Both of those coming out of the investigation into meme stock trading and what was happening.
And predictive analytics as well came out of that.
But those made sense, right? The rest of it, we're looking at the GameStop meme stop report that came out, and there was no smoking gun when there was nothing fundamentally broken in our equity markets.
Well, I think what was fundamentally broken was trust, and that concept of people feeling like the markets aren't designed for them. We have to, as an industry, solve those problems and talk about how it actually works so that you can rebuild that trust. It brings me to another area where you see a market reaction to a lack of trust is shifting from TradFi to crypto or DeFi, or we use the word crypto to describe so many different elements of digital assets. But you're seeing that again as people saying, hey, the markets weren't designed for us. Let's find a new way of doing it by removing intermediaries. During last year's session on this panel, we talked a lot about digital assets and crypto, and the landscape has changed so much over the past year. Some of the firms that were major players at that time are either no longer in existence or a shadow of themselves. We've seen progress on a Bitcoin ETF, not necessarily live yet, obviously, but mostly through the judicial system. We've seen the courts saying, hey, we shouldn't let regulation get in the way of innovation. But it is harder to regulate, especially DeFi. So Professor, I'm going to start with you. Have investors been protected to date when we look at digital assets, and where are we heading from here?
Well, the easy answer to that is no, for a number of reasons. But a lot of people, I think, really misunderstand digital assets. It's not really a new asset class. It's really a new settlement rail. What we've done is we have recreated bearer assets in digital form. And they have some tremendous uses. You can trade them around the clock, around the world, with, hopefully or theoretically low transaction costs. That's very useful. And they're programmable in that the traditional stocks and bonds we trade are really dumb contracts. But the fact is, we have programmable assets that can do things like execute themselves, whether it is something like an option that can execute itself, or the tranche of an asset-backed security. We can do so many different things with this technology that is really exciting. And that's why people go, wow. But it's fascinating to watch this complete rethinking of what we do, from the ground up. But what we've also seen is people reinventing many of the traditional intermediaries that we depend upon. And we've seen people demonstrate the fact that we need to have appropriate regulation in our financial markets. And unfortunately, our regulatory system has been so slow, and we have so many gaps in our regulatory edifice that people have not been well served. So definitely, I think we can do a much better job in providing appropriate rules for so-called digital assets.
We haven't seen really anything change on that front since we were here a year ago, despite the fact that there's been a lot of, there continues to be investor interest, both at the retail level and increasingly at the institutional level as well. So hopefully we do have some clarity, because I do think the protections are so critical. And decentralized exchanges are completely different from the centralized exchanges that we often talk about. I think people don't understand that component as well.
Although I think people also misunderstand the DEXs, or the decentralized exchanges, in that they think, oh, there's nothing there that can be regulated. When you examine these closely, there's always some degree of centralization. There's a group of core developers. There are a group of people who have governance tokens. There's somebody who's got the administrative keys who can change the protocol. So there are things you can regulate there. But we are seeing some movement in Congress with various stablecoin bills. And it's a classic example of how not to regulate things. So instead of coming up with a sensible regulatory scheme, Congress is basically saying, you can choose from 55 different regulators. I'm serious about this. For, if you want to issue a stablecoin in the US, you can do any of the multiple banking regulators, securities regulators, commodity regulators, or state regulators. So we're going to create this, I was about to say unlevel playing field. That's not a field. It's going to be rolling hills of possibilities for regulatory arbitrage and a race to the bottom.
I think there is some hope for retail investors around a Bitcoin ETF, right? I mean, with the reversal of the grayscale decision, and there's an action point at the SEC in probably mid-January. There are 8 or 10 Bitcoin ETFs lined up. I think there's high hopes that there'll be approval. That will give retail investors a well-regulated institution to deal with, a way to be protected when they invest in Bitcoin. It'll shift them from dealing directly with the Bitcoin exchanges, which are more or less regulated or more or less unregulated, to dealing with recognized institutions that make the disclosures, do the registrations, and are held accountable for the protections. So we think that's a positive step.
Progress. Okay.
Long overdue. Progress.
Yes. Another area where the SEC has focused is in environmental, social, and governance issues, and using the legislation and a regulatory environment to encourage certain behavior, whether on public or private companies at this point. what role should the exchanges play in that? Certainly your listed companies are facing everything that's coming out of the SEC on that front. How do you think about what's been proposed and what can you do? And Hope, I'll start with you.
Sure. Well, I think it goes back to what you said a moment ago, Stacey, that investors are expressing themselves by investment in different ways today, not necessarily looking for a financial return, but looking to advance some of their own goals, and whether that's an environmental goal, a social goal, to some degree, governance. So on the investor side, there continues to be investment driven in that way. For the issuers, their shareholder engagement is at an all-time high. They're trying to manage engaging with their shareholders, being responsive to their needs, at the same time reacting to what has really developed into a kind of a cottage industry of issuers being rated by unregulated entities, issuers getting surveyed for how they're approaching ESG issues. So I think the tension there is that issuers are trying to do the right thing by their shareholders, by their large, long investors. Sometimes they don't even know who holds them because short disclosure is not required. So issuers are in a really tough spot in the normal course, and then layer on the many disclosure requirements, which have some derived from Dodd-Frank, others are coming out along the way. So I think it's a tough landscape for issuers today that they're contending with. For the exchanges, from the exchange side, I mean, our principle is really founded in providing our issuers with tools to comply with all of these tensions. And of course, part of our listing standards are grounded in compliance with the federal securities laws. So we think our role is much more one of providing tools for them to comply, providing convening power so that they can understand what their peers are doing, which is critical when you're in disparate geographies, different industries, but all at the end of the day, subject to the same regulatory requirements, both onshore and offshore. A lot of this is coming from Europe. A lot of global reporting companies are contending with European regulations. And so some of this stuff at the SEC isn't quite so controversial. That's different. So different issuers have different reactions to all of this. And we try and spend our time convening them, helping them understand how to tackle these problems and concerns that they're hearing from their investors.
I think in some ways, though, NASDAQ and NYC have taken a different stance on some issues, maybe not necessarily all of them, but certainly diversity. And I've seen NASDAQ adopt a rule around board diversity and other components. So how do you think about it, Jeff?
I don't think it's that different, frankly. I think we, like Hope was saying, we listen to what our issuers are telling us and focus on the governance aspects of our role as a listing market, and creating a market-driven approach to allow issuers to express themselves in the way that they want to. And so that's with the diversity rule, that was entirely around disclosure and allowing them to respond to the market forces they were feeling. This comply or explain gives every issuer on our market the opportunity to express themselves in the way that they think their stakeholders are expecting, as opposed to a quota or something more prescriptive. And I think that's been our approach to ESG as well, giving the issuers the tools, compliance tools to express their view of sustainability or whatever it may be in the way that their stakeholders expect.
So go ahead, Professor Angel.
Oh, I just want to throw in from a public policy perspective, there's a strong argument for why polluters should be required to disclose. But why are we limiting this to public companies? The EPA already requires quite extensive disclosure of pollution in a number of different areas. So why are we allowing some private companies to do dirty deeds in the dark and putting all of the cost on the public companies? So I think from a public policy perspective, we need to rethink, is the Securities and Exchange Commission really the right place to be doing this? Yeah, there are good reasons to have disclosure, but why only public companies?
The state of California agrees with you, right? Their recent legislation just signed by the governor applies to both public and private companies.
Well, sometimes they get it right.
Well, so there are a lot of, we talked about a lot of US regulations when we think about how going offshore a little bit and spreading out the scope. there are a number, there's a lot of legislation around Chinese companies listed here in the US. And I think it's interesting when you think about global dynamics. So I'll start with exchanges and then hear from Sapna and anyone else on this. But what do you think about the US position on companies listing here from China?
Well, I would say, you know, I have a formidable competitor sitting next to me, but our biggest competitor are the private markets and other jurisdictions. We're in a different spot than we were a couple of years ago with the Holding Foreign Companies Accountable Act specific to China. There has been some progress made. There's a lot more, I think, that needs to be made. So when companies have a choice of coming to the US markets or remaining offshore with a different regulatory regime, there are choices to be made. China in particular, you know, a lot of pressure being brought to bear by Congress, by investors, by indices who are looking at companies and different regulatory regimes and making choices. So more to come, I think, but certainly there's been some downward pressure on Chinese issuers in the past 2 years.
I think the only thing I would add is when these edicts come out, they have to consider the interests of individual investors. They have to give investors the opportunity to get out of these securities. They have to, you know, do a cost benefit analysis. There are tremendous opportunities. There's capital to be deployed. There are investment rewards to be gained. I think they have to, you know, hear from issuers, and they have to hear more broadly at the government level from those who are interested, and make sure that when they take action, which of course, you know, we're obligated to enforce the securities laws, national securities interests, no question about that. But they need to hear from issuers, and they need to hear from market participants how to balance the costs and benefits.
From my perspective, it's just impact to the customer base, right? As you guys both put it, some of this is out of our hands, right? The exchanges have to react accordingly. But I think whenever we see, whether it's a Chinese listing or an ADR or GDR that's halted on NASDAQ or the New York Stock Exchange, I'm scrambling because my traders and sales traders are getting calls from their customers saying, we just saw this halt. What does it mean? How long is it going to be in place? What does pending news mean? Or we're collecting more information. And it's really difficult because then we have to reach out to the exchanges and there's very little that can tell us. But the customers are impacted. The investors are impacted because they're holding on to positions that they can't trade out of at that point. So there is real impact to investors as a result.
There was a legitimate gap, right? There wasn't enough audit oversight for Chinese listed companies. And we've talked a lot about trust in the markets, and the reasons why the US markets are so strong is because of our regulatory environment. So that gap did need to be closed. And so I am encouraged, as Hope mentioned, that there has been some oversight. But shutting the doors on the US to outside companies coming, we shouldn't take our position for granted as the markets of the world. And so if we start to see a lot moving internationally, we could cede that seat that we have. So I'm glad to see that problem solving has found its way into this debate over the past year.
The protection of investors issue was present in the halting of the Russian securities as well, right? I mean, just again, responding to geopolitical events. The information flowing from the government in that case was very iterative and non-transparent. And so I think that really was a challenge for us. I'm sure it was a challenge for you and your customers to follow. Everybody wants to follow the edicts, but learning what those are, how they're implemented, how to protect investors when they come is really, really challenging.
Thank you. So I want to leave some time for Q&A, but I have one more question that I'm definitely going to get in before we do that, because when you hear about all the conversations and topics that we talk about, market structure proposals, you might think the markets are broken and that we have so much to fix. And I certainly would argue it's the opposite. Our markets are so incredibly strong, but we don't do a great job about telling our own story and telling about not only the strength of our markets, but why finance in general is so important for this country and our nation. And so I want to end on the positive and have the sense of trying to correct that wrong. Like, let's tell our story. So I'm going to have each of you answer this one. And I want to know, one, either, what are you most proud of in your current organization, or what your organization is doing that's good for society? And what are you most proud of that we've accomplished either as an industry or that organization? Or what good are you performing at your organizations, and what are you most proud of? Or either or. Jeff, go ahead.
So NASDAQ is a very purpose-driven organization. We have a goal and a mission, twofold, to become part of the trusted fabric of the financial services industry and to promote inclusive capitalism. So I'm really proud of our entrepreneurial center out in San Francisco, where we bring together entrepreneurs, mostly in the private market space, to try to create opportunities for underrepresented minorities and people who have not had the opportunity to grow a business, incubate a business. I'm really proud of the way that we're bringing our purpose and our tools together to help promote inclusive capitalism.
Hope.
Yeah, I would say I'm proud of our promotion of capitalism in an environment where sometimes people are questioning the value of capitalism. I think the New York Stock Exchange is an iconic institution, and we represent capitalism. We represent providing ordinary people with access to the markets. And so the convening power that we have from people from all walks of life, of all levels of society, I think is my most proud element.
Echo a lot of the sentiments. Look, I said this kind of early on. If I were given a blank slate, I wouldn't necessarily create the U.S. equity markets the way that we have them. We're a global firm. We have experiences trading in a lot of different markets. When you tell somebody that there are 60 plus places you can trade an equity stock in the U.S., I think it just boggles people's minds. I'm sure that the current SEC administration, after the GameStop and meme stock events, when they heard that, they probably had the same reaction with the new chair coming in, formerly CFTC, where there's one market pretty much where you trade. But what I'm proud of is, despite the market structure that we had, we've optimized it over the years. And the biggest test to the efficiency of our US equity markets was the early on of the pandemic. And it's not like we did Reg NMS and we didn't touch it. We had the financial crisis and we learned that short sell bans really don't work really well in the US. We had flash crash and we put in place single stock circuit breakers. We optimized market-wide circuit breakers that triggered for the first time during the pandemic and worked efficiently. We had Hurricane Sandy, where we learned that the New York Stock Exchange floor could be flooded and they needed to have an automated way of opening and closing stocks. All the infrastructure that we put in place from the lessons that we've learned allowed retail and institutional investors to continue trading.
Yes.
And I'd say that's what I'm really proud of.
Yeah.
Is what we have isn't broken. It can continue to be optimized, but we should be really careful about breaking something, making too many changes that actually works for investors.
I would second that. When you look back to spring of 2020, every single tool that has been designed over the years was used. Circuit breakers, remote BCP plans for people to go home and run the markets from their living rooms, and it all worked flawlessly. So the industry really does deserve a shout out for that one. Go ahead.
What I'm proud of is the fact that our financial markets help people live better lives. Almost everything we do is improved by our financial markets. If you think about it, our financial markets provide not just a payment system to move money around, but also we allow people to save and invest for retirement. We provide a time machine. We can take earning power that we create today and transport it to the future. Or if we want to buy a house or a car, we can take that future earning power and move it up to the present. We provide a mechanism to bring together the enormous resources needed to fund modern technology, whether it is life-saving vaccines or treatments, or new airplanes, or new artificial intelligence, or new chips. Those all require massive quantities of capital, far beyond what individuals can provide. And yet our financial markets provide means of doing this. We also provide risk management tools, ranging from insurance to options and futures, to allow us to manage the risk as well, something not well understood or appreciated. So I'm really glad that you brought this up, because we really don't do a good job in this industry of letting people know how we let people live better lives with the tools we provide.
Totally agree with that as well. And we saw the markets provide a lot of debt through debt and equity offerings in spring of 2020, so that companies could raise money to go do the things they needed to do to battle the pandemic. And I'm grateful for all the work that all of those companies do while they're creating jobs and growing. So financial markets, good. Now I have a couple minutes for questions, so we'll start right here.
Hi, my name is Vic, and I'm a freshman here in the college. My question is regarding excessive fragmentation. The US has 16 equities exchanges, 7 of which transacted less than 1% of the overall volume on Friday, November 10th. Meanwhile, FINRA TRF reported 43% of the equities volume traded off exchange. For listed options, we now have 17 options exchanges. My question is, are US markets getting too fragmented? Also, if there was no regulatory requirement to route to every exchange, would the 7 equities exchanges that trade less than 1% even exist?
All right. So who wants to take that one?
Oh, I have opinions on everything.
Yes.
Do we have too many supermarkets? Do we have too many gas stations? Do we have too many clothing stores? I'm a fan of letting the competition sort things out. Now, I'll agree that we should probably rethink Reg NMS in a number of ways, but it's sort of like one could say that I have too many children, but which ones do I want to get rid of? None of them.
It's a fair question, right? And I think we share the concern. And frankly, I think I'm on the same trajectory as Sapna. You know, I came to NASDAQ in 2000 when liquidity was really, really concentrated. The SEC had adopted Reg ATS, you know, let 1,000 flowers bloom. And we are really at the other end of the spectrum now. Order flow is really fragmented. There are incentives to spread it out further and further and further. I think the commission has done a really nice job orchestrating the structures of the market. I do think it is time for them to really focus on fragmentation so that we don't lose the central pool of liquidity that helps form the MBBO and really protects investors.
Fragmentation definitely leads to volatility.
Yeah.
All right, next question.
Hi, my name is Monty Singer, and I'm a sophomore in the business school. I had a question. So I am a meme stock retail investor, and I was curious to learn your opinions on AI and whether that's going to lead to more kind of opacity in these large kind of wealth, market makers, or whether it's going to lead to more democratization for these retail investors, and where the opportunity for regulation is in that.
Maybe I'll start. I think, again, the commission has tools to fight fraud and tools to require disclosure. To me, it's not as big a revolution as people have been portraying it. Algorithms run the market. There is not a lot of transparency around algorithms. We measure outcomes, we measure impacts, we set up guardrails. The difference between an algorithm-driven order type or an algorithm-driven routing strategy and an AI one is really, really small. And so I think there's a lot that we can import from current market into AI to help, provide the guardrails and protect investors.
Yeah, I agree. It's almost as if the AI outside of the markets is what would be more concerning, and with misinformation and
Right.
people not having clear visibility.
Right.
But focused on it. Last question.
Kelvin to Data Boiler. Well, first of all, I'm glad the US didn't go into the extreme like Europe banning payment for order flow completely by 2026. But like the SS fee cap, well, I'm glad that it doesn't cut entirely the rebate, right? But like all of a sudden, all this coming along, wouldn't that drain liquidity out of the market significantly? Because like without incentive to go around the ecosystem, right? There could be a liquidity concern if the rules are being adopted, like there's this fee caps, recalibrations and all this. And then I'm just looking into, like, for example, Phil McIntosh as NASDAQ just come out with like an article talking about price discovery and all this contribution and the SIP rebate and all this type of things. Well, shouldn't we look into the music industry, the copyright licensing mechanism, as a way to kind of regain trust about all this rebate or SEC concern about conflict of interest, so that it will grow the overall pie as well as regain the interest like in the markets and regain the confidence like in our public markets. So thoughts?
Using licensing to provide more transparency?
Well, a systematic way, like the royalty payments in the music industry, to consider how rebates and all this should be aligned with right and obligations so that it could potentially improve the overall system to regain confidence about, hey, there wouldn't be conflict because we have a certain standard or disclosure how rebates are being given out and all this. So rather than government come in to regulate ourselves, right, or the pricing control by the government, well, it would be a market-driven type of approach. And music industry has some success story, like proven that work.
Hope, I'm gonna let you take that in the rapid fire answer because we're
fire.
over time.
I mean, I would say exchange rebates are incredibly transparent. Anytime we change our prices, we have to file it with the SEC. The same is not true of payment for order flow arrangements, which are bespoke between two market participants. So I think there is, just like when you're looking at on and off exchange transparency, there is a very big difference in those two pricing mechanisms and how they're disclosed to the public. So I think.
Excellent. Thank you. And thank all of you for joining me up here today, and enjoy the rest of the day.